and welcome to Professor Richard Werner, who's joined us in between flights, which is a commitment to giving a seminar paper. So Professor Werner is the Professor of Banking and Finance at De Montfort University in Leicester. He's worked in a wide range of roles in academia and the banking industry, and he's also published prolifically in multiple languages. And much of his research and advisory work has been focused around causes of banking crises and ways of making our systems better equipped to avoid them. And the title of his talk that he's going to give to us today for about 25 minutes, followed by questions, is The Case for Abundance. High sustainable growth and prosperity are possible. Why don't we get them? So I'll hand over to you, Richard, for about 25 minutes, followed by questions. Thanks.
Great, thank you very much. Now I'd like to start with a topic that actually a lot of people are presently very concerned about because it does affect us on a daily basis. Inflation. And inflation, well, didn't really used to be much of a problem until recently. And so there's a lot of concerns, particularly since there is a probability that inflation will stay with us and actually rise further and become even a bigger issue than it presently is. So first, let's go back to the previous experience we've had with inflation. It was the 1970s. It was a decade of economic stagnation and high inflation, which economists then, putting these terms together, call stagflation. That's US data. Actually, the inflation peaked in 1980 at 13.5%. Index. In 1974 was the first sort of peak, prior lower peak at 11%. And that reminds us that actually we're already very close to these figures in many countries. And it's likely we will experience inflation in the coming months. Now, we were told about the cause of this inflation. And needless to mention, inflation, of course, takes away, particularly from the poor. It makes everything more expensive, consumer prices going up. It affects the rich less than the poor. It's a very regressive sort of economic phenomenon and redistribution, if you want. Now, we were told this inflation, oh yes, there's more figures on some other countries. In the US, you saw 13.5%. The UK was even higher, it was 24%. Japan, 23%. Germany had a lower inflation. And the question is why? Why do we have this inflation? The official story is, the 1970s, well, there was a war in the Middle East, and then there was an OPEC oil embargo, sanctions and oil supply problems. It was an energy supply shock. And doesn't that sound very similar to what's happening now? We're being told, well, it's because there's a war and there is there's sanctions, there's an energy supply shortage. Now, is the 1970s official story actually true? The rule in economics is that the truth is the opposite of what they tell you. So we should be very doubtful of any official story, and particularly this one. And by the way, we are being told by the ECB that, in the 1970s, this inflation, which is very bad, was not going to happen again. The ECB told us in 2000. The euro area is clearly in a better position to withstand an oil price shock and avoid a recurrence of the consequences of previous oil price shocks. And of course, the ECB told us last year, any inflation is just transitory. It will just disappear in a few months, which was also not true. So there's a lot of messages from the central planners and central banks that in reality are not really true. So what was this oil shock inflation that we're told is an oil shock inflation and economic stagnation really due to? Now, to answer that question, and we will use that knowledge also for some other things, it's good to just figure out the basics. And I'm sure Plummen will already I've mentioned some of these, so apologies if there's an overlap, but how does the economy work? And if you understand how the economy works, and it's actually not very difficult, then you can use that tool to yourself always assess, why a certain thing's happening, because it always goes back to the same small number of variables. But to understand that, we need to uncover the secrets of the banking trade and the rules of the money game. Now, if you ask ordinary people, just anyone in the streets, what's important in the economy? Most people will say money, and quite a few will say banks. But if you ask an economist, they will say many, many things, but they will not say money and they will not say banks, because in economics textbooks, they're being suppressed, and you won't find anything on banks in economics textbooks, really. Particularly the more advanced ones have almost nothing on banks or money. Instead, they're telling us, oh, interest rates are the key variable. It's all about interest rates. Now, when it comes to banks, because ordinary people, of course, got it right, banks are very important. How do they function? I was astonished to find there's actually 3 theories of banking, and there was no empirical test of which of the 3 theories is true. The theory that the textbooks tell you nowadays is, oh, banks are just financial intermediaries. They gather deposits, they do their job of evaluating loan applications, and then they lend some of these deposits to the borrowers. That's the financial intermediation theory of banking. That one's been dominant since the 1960s, but beforehand, from the 1930s to the 1960s, there was another theory called the fractional reserve theory, which says that each individual bank is a financial intermediary. So that's the same story, but only the individual bank. In an aggregate sense, when banks work together, and they have to work together collectively, something happens and some kind of money creation is going on. And they even talk about a money multiplier. Now that told a lot of people, oh, there's something happening here that's interesting. And I think because that was too interesting, they pushed the financial intermediation theory since the 1960s. Nothing to see here. They don't mention money creation, and that's become the dominant theory. And banks and money is entirely dropped from economics. Now, there was an earlier theory which was dominant until the 1920s, 1930s, the credit creation theory. And that one says each individual bank creates money, each individual bank, and banks are not financial intermediaries. They're very different. They're actually creators of the money supply, and any loan that is given by a bank creates new money. Now that seems a bit surprising if you haven't heard this before, and seems almost impossible. Anyway, there's these 3 theories, and how can we find out which one is correct? The 3 theories differ actually on that point. When a bank gives out a loan, where does the money come from? And that's where I thought, well, we need an empirical test. And for that, you need a bank that cooperates. And then I actually took out a loan, and the bank was monitored, the transactions, the accounting, the IT operations of the bank were monitored, and then we can see what actually happens. I mean, that's scientific work, isn't it? You check the facts and you observe the facts, and that's how you can test theories. And economists think banks are deposit-taking institutions that lend money. But once I did this empirical test, I found out that actually that's not true. Banks are not deposit-taking institutions that lend money. So here are the 3 theories: financial intermediation theory, fractional reserve theory, credit creation theory. And the empirical finding in this test was that banks don't lend deposits. So that first one was rejected. Banks also don't lend these reserves, there's this fractional reserve theory where you need excess reserves to lend. That's also not how it works. It turns out that actually when you go to a bank and you borrow money, your account will be credited with the money of the loan. And this money that your account now shows as a positive balance that you have as a deposit, which of course you haven't deposited. Actually, if you trace the transaction, where does this number come from? Which account was it transferred away from into your account? It turns out it wasn't transferred away from any account. It was newly created by the bank, which credits your account when you borrow money. So it's created out of nothing. It's created into existence by the bank. And at law, it becomes actually more apparent that this is how it works. If you're interested, just very briefly, we can maybe later talk a bit more about it. To me, it was actually quite illuminating once I hit on the legal side of things, because it's very clear at law. Banks are not deposit-taking institutions, and banks don't lend money. Why? At law, there is no such thing as a bank deposit. At law, what we call, and also banks colloquially call, bank deposits are simply records of the bank's debt to us. And at law, the loans we've given to the bank. So they have no special status. They're just credits that we have given to the bank. It's a loan. So banks don't take deposits. We lend them money. That's as far as the deposits go. What about the claim that banks lend money? Well, they don't actually. So, and this goes back to my empirical test. So when you get a loan, the loan contract is a security, a debt instrument that you have issued, that the borrower has issued. The mortgage is a debt instrument that the borrower has issued, and the bank is in the business of purchasing that debt instrument. And you'll say as a borrower, well, I don't care, I want to see the money. And the banker will say, you'll find it in your account if they're careful. If they say we've transferred it to your account, that's actually already incorrect, because it's not a transfer. But the borrower's account is being credited. Why? Because, remember, there are no deposits. It's just a record of what the bank owes you. And because you've borrowed the money, and the loan contract also says the bank's going to give you money, the bank owes you this money. And so they make a record of their debt to you, which we call a deposit, and which you can use as money. And that's how the money supply is created. So the textbook story of banks as financial intermediaries, gathering savings and lending them out, and also the fractional reserve theory, are rejected by the empirical test. It's now established that banks create money. If you want to read up the paper, it's Can Banks Individual Create Money Out of Nothing? It's open source. There's a second test I did in 2016 called Lost Century in Economics, because for the past century, this was not recognized, and therefore all these economic theories are quite worthless, because this is, of course, a crucial factor in the economy. So if you take out £100,000 loan, let's say, the bank will purchase the loan contract, and that's an asset that increases the bank's asset side. The bank owes you the money, and therefore it credits you with that amount, which we call a deposit, which you haven't made, but it's a liability to the bank. So of course the balance sheet balances, and you find this in your account with the bank. But where does 100,000 come from? Bank liability in your account. It's not transferred from anywhere inside or outside the bank, as I established in this empirical test. Now that's a game changer. Banks create money, a real game changer. And when you realize that, then of course you realize you have to include this in any analysis of what's going on, any analysis of policies. Also, it shows us there's many opportunities. Banks are very powerful. They decide who gets newly purchasing power and what it's used for what purpose. And of course, banks' decisions about how much money to create and who to give it to will change the economic landscape. That tells you that we need to have the right type of banks that make decisions that are good for local communities in particular. And when you have a very concentrated banking system with a small number of very large banks, usually not very good. So we can, once you know this, you can also then you realize that you can solve all the problems we have. We don't need to have banking crises. We don't need to have unemployment. We don't need to have business cycles. We don't need to have underdeveloped countries or poverty. We don't need to have depletion of finite resources. Abundance and prosperity are possible if you deploy bank credit creation properly for the benefit of the people. But the precondition is the knowledge that this is how the system works. It's all driven by bank money creation, and the money creation is out of nothing. How does this link to the economy? Well, bank credit, abbreviated here with C, can be used for transactions that are part of GDP, part of the economy, that contribute to national income. That's the green arrow here. Credit for the real economy, but it can also be used to purchase assets. And when it's used to purchase assets, it doesn't contribute to GDP, but it does something. In fact, this is the left side here. When you have credit for non-GDP, for financial transactions, this is unproductive and unsustainable money creation. It's like money printing pushed into these asset markets, property markets, real estate markets. It will drive up asset prices. You get asset inflation, an asset bubble, and that will also ultimately lead to a banking crisis. That's why we have these recurring banking crises. It's whenever banks have created too much money for asset purchases, which is always unsustainable because there's no intrinsic income streams to service and repay the loans. Now, there's two other possibilities. If banks create credit for GDP transactions, that's the right side. We have two possibilities. One is what gives us inflation. And that's also what we've had since 2020 happening a lot. When banks create credit and it's used for consumption. And of course, because what you're doing is you increase demand, you increase purchasing power, you increase spending, but you haven't increased the amount of goods and services in the economy. So there must be inflationary pressure. Of course, since 2020, at the same time, we had a restriction of the supply since 2020 under the banner of some kind of medical measures, which of course are unprecedented in medical history for purely medical purposes, but that's another story. Anyway, so supply was restricted, and more importantly, we increased demand tremendously by creating a lot of money for consumption. That's why we have inflation, and we'll now with this tool also we can go back to the 70s and see what happened there. But there's one more case I need to talk about, and that's the green box here. This is the redeeming feature of the banking system. When banks create credit, and this is used for productive purposes, for the creation of new goods and services, for implementing new technologies, for increasing productivity, what you get is more economic growth, more job creation, but no inflation, and essentially no negative side effect from this money creation. So successful economies have made sure that bank credit is used mainly for this case 3 here, the green box, and not for the other possibilities. Those economies that are not so successful and don't have such high and sustainable, growth, but instead have boom bust cycles, well, and of course the UK is an example. It's because they've created too much credit for mainly asset transactions, or sometimes, as now is happening, for consumption, which is always unsustainable and creates problems. And it's very predictable, actually. The East Asian high growth economies, they ensured that bank credit creation was mainly for the green box. Then you get very high economic growth. We can have higher economic growth at at any level of employment, even at full employment, we can still have higher economic growth, and also without hurting the environment, as long as the economic transactions are not harmful for the environment. Growth is not the enemy of sustainability. because actually economic growth doesn't even exist. It's just an accounting fiction, and an accounting fiction can't hurt the environment. Some people say we need zero growth for the sake of the environment. But of course, we can have zero growth and still hurt the environment, quite obviously. If we have harmful activities going on at zero economic growth, we will still hurt the environment. Likewise, we can have high growth and be very sustainable, environmentally friendly. That is also very, very possible. And of course, that's what we should be doing. And there's more here on some details on these asset bubbles, which we can either skip or return to later if you're interested. You know, it's always the same mechanism. You know, when bank credit is used for these financial transactions, CF, in Japan, for example, is doubled from 15% of total lending to 30%. And the total lending, of course, was also rising. You get this huge asset bubble as in Japan in the 80s. And then it's a Ponzi scheme, a game of musical chairs. It works while bank credit creation for asset transactions continues to grow, because then you have further capital gains. Then the game continues. But as soon as the music stops, as soon as CF, credit for financial transactions, stops, then the house of cards collapses, and we have a banking crisis, and the asset bubble bursts. It's always been the same. If you just go back to the US, 1920s, asset bubble, then big bust, Great Depression in the 1930s, Japan in the 1980s, big asset bubble, then big bust, 2 decades of Great Depression in the 90s and 2000s. There's many examples. There's always the same game. So, for example, this is Japanese data in the 80s, broad bank credit rising much, much faster than GDP growth. That's the asset bubble. That's going not GDP, but into asset prices. Then they tightened, and once that happens, then you get this negative downward spiral. Okay, so now we understand the mechanism here for economic growth and prosperity. So let's go back to the 70s inflation. Was that high inflation of the 70s, which actually was quite a negative era for many people, because before then, in the 60s, there was a lot of optimism. Also, economists were proclaiming we can solve all these problems, we can have prosperity, we can have abundance. That was the view. But the 70s changed that, and it was all suddenly about limits and finite resources and problems, and you know, this idea of abundance was gone. Prosperity can't be expected. But what was really the mechanism behind this 1970s inflation and stagnation? Well, we just need to look at credit creation to see what's really going on. We were told it's because of the Middle Eastern war and then the OPEC oil embargo. Now that happened from October 1973. Okay. But bank credit growth ballooned in June 1971. This is US data. We had 14% bank credit growth. And that is what created, you know, it takes time, it takes 2 years. That's what created the inflation from late 73. It's this massive expansion in bank credit creation. We saw that also in Germany, bank credit creation expanding in 72 by 14%. The peak was March 73. That precedes the Middle Eastern, you know, OPEC oil price story they're telling us. That's what created this inflation. Look at Japanese data, massive expansion in 71, 72, peaking in December 72 at 26%. And then you wonder why we had 23% inflation in Japan 1.5 years later. So that's the reality. Now, this bank credit growth is very much under control by the central bank. In some countries, like in Japan, the central bank very directly tells the banks how much credit to create, precisely because it's the key tool that drives the economy. And they also tell them which sectors should benefit from this and which sectors should receive, you know, the new purchasing power, which is a very positive tool when you use it for positive purposes, as they did in Japan until the mid-80s. Then they used it as a negative tool to blow up the system. and they told the banks to create credit for asset purchases, creating this huge asset bubble. But in all cases, it goes back to decisions made by the central bank, the central planners at the central banks have been behind this, and also the 70s inflation, as my empirical work shows. So back to the present inflation, and using US data here, many people compared this to what happened in 2020 when we had apparently some kind of sort of health emergency. They compare this to the 2008 financial crisis and the very active central bank intervention to help the economy. And let's quickly compare this to 2008. Now, this period, in fact, where this blue line is jumping up, that is 2008 October. That measures the Federal Reserve's activities, and they totally expanded their activities and injected a lot of money into the system. So a lot of people then said, oh, this quantitative easing is going to cause inflation in America, and also the dollar is going to collapse. I was one of those fewer economists who were saying, no, we will not get inflation, and the dollar is not likely to collapse. And it didn't, and there was no inflation. And the reason is that the central bank is a very small little cog, and the banking system is much, much larger. Of course, the central bank can influence the banks, but you have to measure what all the banks are doing. And that's the gray line here. You see that in the 2008 crisis, the problem was that bank credit was collapsing and then turned negative. So that's why the broad money supply was actually shrinking. And at that time, the central bank became super active, which looks very inflationary, but actually the central bank normally only creates 3% of the money supply. 97% is created by the banking system. And the banks, which are much bigger, that's a big wheel. Central bank's just a tiny cog. The banks were restricting credit, therefore the money supply was not expanding. Therefore, you could not have inflation, despite the central bank being hyperactive and this tiny little cog spinning very fast. That couldn't make up for the banks not creating any money. That was the situation then. Now let's look at March 2020. Bank credit was already positive, 6% credit growth. Now that's plenty for steady economic growth. But the central bank also stepped in and did its very active money creation, and the banks were forced by the central bank to increase money creation further. They actually pushed it up from 5-6% to over 10% double-digit money creation. Then after 1 year, that fell back, but actually since then it's risen again. So the gray line, bank credit is expanding at almost 10% again. So it's clear this inflation is not just a temporary phenomenon. They are creating a lot of money, and that's why we're getting this inflation. It's the same in the UK and also in the Eurozone. And so comparing these two time periods is really revealing the difference is the gray line, bank credit creation expanding dramatically, and that's the money creation. So it's very simple. It is a story of money creation, but perhaps slightly more sophisticated than the simple one. Money creation equals inflation. No, not always. It's the use of the money. And there's three cases. If the money is used for consumption, you get consumer price inflation. If the money is used for asset purchases, property, real estate purchases, then you get asset price inflation. But if it's used for productive purposes, you don't get inflation, you get growth. And that's what we need. But unfortunately, that's not happening. And one reason is that people don't seem to be aware of this. And this knowledge has been very much suppressed quite actively in economics. It's very hard to publish on this. It's a taboo topic to talk about bank credit creation. Since 2008, it's become perhaps marginally better. And also since my papers managed to get through the censorship and get published, which often, has taken many years for each paper. It's become a bit easier, but still there's a lot of resistance. And so the right policies are not yet being taken. And of course, the other angle is that the establishment pushes the interest rate narrative, saying that no, the key variable you need to look at is interest rates. If we raise rates, that slows the economy, and now we need to slow inflation. We're going to raise rates. If you want to stimulate the economy, you lower rates. Or we had, rates very low. That's why we have inflation. I don't have the pictures for this one here, but I also did some empirical research on this where I disproved this official narrative. Interest rates are not negatively correlated with economic growth, as they always claim. There's a paper, you can look it up, it's open source, called Reconsidering Monetary Policy. You will get it quite quickly online if you search for it.
Richard, just to let you know that we're at time.
Okay,
so
excellent. Well, that's
minutes, good. I just want to leave time for
that's
questions.
very good. That's very good. That's perfect timing. I will actually then just come to this point here. So, namely the positives. You've seen the mechanism. So how can we use this for abundance? What is the case of abundance? Well, credit creation for productive purposes, the green box. And of course, how can we address issues such as the looming food shortage? The government doesn't seem to be really working against, it doesn't seem to be working to prevent this, but quite the opposite. All we need is credit creation to encourage food production. That includes agricultural, farming support, and we will get more food production without inflation and without any negative consequences. Also, we need to help all parts of the economy to become more decentralized. We need to support localism, and the best way to do this is actually have a banking system that's decentralized and is local. We should establish many local community banks that only lend locally, and that means also they would support local farms, local energy production, local industry, local trade. A decentralized banking system is much more stable and resilient, and also will deliver almost automatically without the central bank telling them who to lend to. They will always deliver more productive credits, the green box, and they will support the local small businesses, the local farms. They will create jobs. We see this when we compare the UK with particularly Germany, Japan, and the US, which have many more banks than the UK, and they have hundreds, if not thousands, of community banks. And then you get much more local growth and decentralization and stable growth as well. So we can do this if we set up small local community banks, because of course large banks lend to large borrowers, not to small firms. But most jobs are with small firms. 2/3 of jobs also in the UK are with small firms. Who lends to small firms? Only if you've got small banks. But in the UK, we've got 5 big banks dominating banking. 90% of deposits are with the big banks. That's a problem. We need to set up small local community banks. In the UK, most credit is for financial transactions. It's the asset purchases, the asset bubble, hence the boom bust cycles. If you look at the breakdown of UK lending, 56% is property lending, 30% is financial credit for asset transactions. There's only 14% that's not for asset purchases, which is sad. That's not really good for the economy. It doesn't mean you shouldn't support mortgages, but you can have non-bank mortgage companies that can provide credit for those purposes. Germany has been very successful, even beating Chinese exports, because they've got many small community banks. And there's hidden champions is a concept when you have small and medium-sized enterprises that are global market leaders in their market niches, having top market shares, 1, 2, 3, number 1, number 2, number 3 in terms of market share. And we see that Germany has most hidden champions in the world, followed by the US and then Japan. And of course, these top 3 positions are because Germany, US, and Japan have lots of small banks. Germany is the most extreme. 80% of all banks are community banks, not-for-profit community banks. And that's why Germany is doing so well in terms of productivity, because the small firms can constantly upgrade. They get a loan immediately when the new technology comes out and they need this from their local bank. Germany, you see here, this is the number of banks in European countries. Germany, of course, has by far the largest number of banks. So what we need to do is set up more community banks, which we're doing. Local First Community Interest Company is a company Plumman has supported quite a lot in the past, and I'm working there to set up community banks as well. There's the Hampshire Community Bank. The University of Winchester is actually one of the shareholders as well, and that has many positive effects, including increasing this decentralization and localism, and that includes, of course, also supporting local farms and food production. There's more, if you're interested, New Paradigm in Macroeconomics, or particularly, that's for the general reader, Princes of the Yen, at quantumpublishers.com. Thank you very much.